Let's talk about why revenue and expenses change equity. Now, we've already put in place some very foundational accounting ideas that we're going to continue building upon throughout the duration of this course. On day one, we established the fact that all companies are transformation systems. Companies take resources and via their productive processes, they transform these resources into valued outputs for customers. Now, we also established the fact that all companies are affected by economic events, okay? And we termed this economic reality or business reality, okay? We know that business reality is inherently chaotic, and we need some kind of system that's going to represent this reality so it's interpretable, okay? And that's where accounting comes in. The accounting system is effectively going to take all of this chaos and help us organize it. Now, the accounting equation is the foundation of the accounting system. We have assets, liabilities, and equity. And this equation, this identity, is going to sit at the base of literally every single business. Okay, so that's kind of where we're at up to this point. Today, we're going to focus on equity, which is also known as the residual claim on a company's net assets. Okay, and we're going to get into exactly what that means throughout the duration of this video. But for starters here, just know that if we could say that assets equal liabilities plus equity, this is the traditional accounting equation, as you know, then using simple algebra, we can rearrange this equation to say that equity equals assets minus liabilities. And all we're saying here is that if we take all of the resources that a company owns or controls, okay, these are the assets of the business. And if we subtract all creditor claims on these assets, we're going to be left with the residual. And you probably know what that word means. Residual just means what's left over. Okay. And that's exactly how we derive equity. Equity holders are going to receive what's left over after creditors are paid. Okay. And that's really what I want you to walk away with from this video. So today we're going to focus on what happens to that residual interest when a business makes money. Okay, this is a very interesting topic, and this will expand your understanding of finance and accounting and just how it all connects. So definitely stick with me throughout this. So earlier in this course, we established the fact that all companies capture value, right? That's how they sustain themselves. And within the company's productive process, they had to consume resources. Okay, that's pretty straightforward. And if we take the value captured and subtract the resources consumed within the company's productive process, we're of course going to be left with the economic surplus. Okay, we know that by now. Now let's put some more familiar terms onto these kind of vague economic terms. Okay, you probably know value capture as revenue. You probably know resources consumed as expense, and economic surplus as net income. Now, these are conceptually related. Do not conflate value capture and revenue, resources consumed and expense, and economic surplus and net income. These are conceptually related, but they are distinct concepts. But I'm just trying to draw that connection between business theory and accounting theory, and accounting practice, I should say. To make this make sense, let's walk through an example, okay? So we have assets equal liabilities plus equity, okay? So it seems here that the business owner has invested 100K into the company, okay? So assets are going to increase by 100K. And since this capital came from the business owner, liabilities are going to remain unaffected, okay? Because the company isn't borrowing anything. So equity is going to increase by 100K. Okay, pretty simple there. Now let's assume that the company earns $10,000 for services provided to one of its customers. Okay, so cash, which is an asset, is going to increase. So assets over to the left here are going to increase by 10K. Now, the company obviously did not borrow these resources. The company earned these resources, so liabilities aren't going to be affected. Equity is going to be affected, and it's also going to increase by 10K. The basic flow here is whenever a company earns revenue, net income increases, and net income flows into an account called retained earnings, which is a component of equity. Now, let's assume that the company pays $3,000 in wages. This is a cash expense. Cash is going to decrease by $3,000. So this is going to reduce assets by 3K. Liabilities obviously aren't going to be touched. Equity is going to be reduced by the same amount, okay? Whenever a company incurs an expense, net income decreases, okay? And net income, as we stated, flows into retained earnings, which is a component of equity. So if net income decreases, then equity decreases, okay? That's the basic pattern that I want you to understand here. So for the period, the company brought in $10,000 of revenue, had expenses of $3,000, and of course, that's going to amount to net income of 7K. And this fundamentally is how the income statement and balance sheet are connected. So every accounting period performance is going to flow into the balance sheet, okay? So we have beginning equity, whatever the beginning equity happened to be for any given accounting period, plus net income, okay? That's going to be the change throughout the period. And that's going to get us ending equity, okay? So the business generated $7,000 more than it consumed, okay? And this belongs to the business owners, okay? That's the main takeaway here. So performance is going to accumulate in an account called retained earnings, okay? So if we take revenue minus expense, we know that gets us net income. And net income, as we have established here, is going to flow into retained earnings, which is a component of equity. Okay, so that's how the balance sheet and the income statement are connected, and that's how the income statement essentially feeds into the balance sheet. The main takeaway from this video is the fact that equity is never static. It's always being updated by the company's performance within any given period, okay? So we have beginning equity. This is always our starting point, plus any contributions, and you could think of contributions as capital contributions, we could say. You could think of these as any kind of investments from owners that aren't related to earnings, okay? So this is owner activity, we could say, plus net income, and then we know that net income comes from the income statement minus any distributions to owners, okay? And these can be thought of as dividends or are typically called dividends. And that's going to get us to ending equity. So, okay, so equity is always changing. Equity is always being updated by these kinds of activities: contributions, net income, and distributions. Let's conclude this video by tying everything together. So we know that assets equal liabilities plus equity. Okay, this equation is the foundation of the balance sheet. As a matter of fact, it's the structure from which the balance sheet is generated. Okay, so this is foundational. Equity has two main components, okay? Equity is comprised of contributed capital and retained earnings, okay? These are the two main components of equity that you need to know about. Now, retained earnings is going to change over time, and to be more precise here, retained earnings is the bridge between the income statement and the balance sheet. Now, I'm going to say that again because this is foundational information. Retained earnings is the bridge between the income statement and the balance sheet. This is the mechanism by which equity changes within any given period, okay? So we have beginning retained earnings. This is going to be found on a company's balance sheet. Net income, as we know, is derived from revenue minus expense. That's very simple, and this is going to be found on a company's income statement. Minus dividends. Dividends are simply distributions to the owners of the business, to the shareholders, is going to get us ending retained earnings, which, of course, is going to be found on the company's balance sheet, okay? And so this is how retained earnings, or I should say, this is how the income statement essentially feeds into the balance sheet, okay? And here's how it all connects. So at the top here, we have assets equal liabilities plus equity. Now we have further decomposed equity into its main constituents, namely capital and retained earnings. We know capital represents essentially investments from owners or business owner activity, okay? This isn't related to the earnings of the company. And retained earnings is going to be a function, or is going to change as a function of revenue minus expense minus dividends, okay? So this right here is the entire accounting system. That's the best way you could think about this, what I have on my screen right here. We know that assets equal liabilities plus this expanded view of equity, okay? That's the best way you can relate to the accounting equation. And I really like this diagram here because it essentially explains how the income statement feeds into the balance sheet and essentially updates equity within any given period, okay? Now, if you like this kind of stuff, definitely consider subscribing, comment if you have questions, and stay tuned. Thank you.